What's up, investors? It's the Russian dude. In today's short video, let's talk about how cutting the rates can temporarily boost the stock market after most likely market decline, which will follow right after the Fed pivot. So let's talk about all of these things right now. The very basic understanding how these interest rates influence the US economy is the following. Well, it makes sense. The higher the rates, the higher the mortgages. The higher these rates, the higher your interest payments you make on, for example, your car, your credit card bills, things like this. So long story short, it kinda slows down the economic activity. People are no longer buying houses, not buying that many cars, waiting for better conditions, specifically for lower rates. And at the same time, the fixed income securities yields, for example, government bonds, treasuries, they go up as well, decreasing at the same time their prices, which basically means a lot of people consider investments in such financial assets to be more interesting, to be more profitable and way safer than investing on the stock market. For this reason, people take money out of the stock market, they buy these fixed income securities, and they enjoy pretty much fixed income. Well, at the same time, it obviously drops the prices on the stock market, bringing the stock market itself down. And at the same time, when rate cuts will start to happen, which once again most likely will happen by the end of this month, first of all, one of the very first things which will be influenced are the yields of the very same fixed income securities, government bonds, treasuries, and so on. Which basically means fewer and fewer people will find investments in such assets less attractive. They will prefer to sell their fixed income holdings and start to pour money back into the stock market. So once again, potentially, most likely, I'm not giving you 100% probability the stock markets are irrational. We also talked about this thing in the past, but according to the very basic economic models, literally economics 101, this potentially will boost the stock market up, at least temporarily. It is also potentially expected that the sector which will benefit the most from this is the technological one, because technological shares of companies are the ones who drop the most whenever the markets are not feeling that well, because also these companies are relying heavily on the borrowed capital, and whenever the rates are high, they cannot use that much capital to advance their business activities, to do research and development. So first thing, when the rate cuts will start happening, these companies will be able to borrow additional capital at a way cheaper rate. That's the first benefit. And the second benefit when the rates cut will happen and when the money will start pouring from fixed income securities back on the stock market, these shares of technological companies are usually the ones which are going to be mostly oversold. So people will start picking them up at a pretty good bargain prices. But we cannot forget one thing, is that traditionally, historically, as soon as this Fed pivot happens, as soon as they start cutting the rates, in our case, once again in the next couple of weeks, this, first of all, will trigger the stock market decline. As you can see from this graph, it has been happening every single time after Fed pivot. But then, when people realize that they overreacted, when the companies are oversold, when the shares are at very bargain prices, and when the capital starts flowing from fixed income securities into other regular stocks, shares of companies, well, this is when most likely, inevitably, this will lead to a market uptrend. This is just my own observation, guys. Please don't base your investment decisions on my findings. Please do your own research. If you want to continue investing money, do it your way. This is just a food for thought. And as always, thank you so much for watching. Please like this video, subscribe to my channel if you found it useful, and see you tomorrow.